Okay, so in this podcast, in the course International Finance, we're going to discuss the so-called Peso problem. So, when talking about the Peso problem in more general terms, you could say that it has to do with a small probability of a large change. Because generally asset prices are determined by expectations, and if the investors anticipate large discrete changes, for example market crashes, then this will directly affect asset prices, because then they will be less willing to hold the assets if they anticipate large market crashes, for example. So what is the Peso problem in these general terms? Well, then we talk about the fact that a small probability of a large change can have a large impact on prices. So if these changes have not occurred in the sample, then the sample returns will seem out of line with the risk estimated from the sample, simply because these changes have not occurred in the sample. So even though the investors anticipated these large changes, they might not have occurred in the sample, and then the sample returns seem to be out of line with the risk estimate from the sample. So what is the origin of this term? Why is it called the Peso problem? Well, it was first noted in the Mexican peso market, so that's why it's called the Peso problem. And the original source of the term is unknown, but it has been attributed to Milton Friedman, who received the Nobel Prize in 1976. And you can see him down below to the left, and it's quite interesting now that you can find many of his talks and debates on YouTube. So they've come a bit to age now, but I think they're still relevant, although I don't always agree with him, of course. It was first mentioned in writing in Kenneth Rogoff's doctoral dissertation from MIT in 1977. And you can see Kenneth Rogoff to the right down below. So the original Peso problem had to do with the Mexican currency crisis, and this was what Kenneth Rogoff studied in his doctoral dissertation. So what was this Mexican currency crisis about? Well, this was around the mid-70s, and at this time the Mexican peso was pegged to the US dollar, but the interest rates offered by Mexican banks were much higher than those offered by US banks. And also, futures and forwards were sold at a heavy discount, meaning that if you looked at the US dollar per Mexican peso forwards, those forward prices would be much lower than the spot prices. And so then many traders used some version of the following strategy, where they first borrowed in US banks because the interest rates in the US banks were very low, and then they exchanged the US dollars into Mexican pesos, deposited them in a Mexican bank at this high interest rate, and then finally they exchanged the Mexican pesos back into US dollars. And since there was a peg here, you could make a lot of money using this strategy. And this type of strategy is called a carry trade. But then, on the 31st of August in 1976, the Mexican authorities allowed the Mexican peso to float. So the Mexican peso then fell from 0.08 US dollars per Mexican peso to 0.05 US dollars per Mexican peso. So this was a devaluation of about 46%. And of course, these carry traders used some version of the strategy that I talked about before. They lost a lot of money because of this devaluation. And of course, the forward futures prices and the interest rates reflected the possibility of this devaluation. So, what can you learn from all of this? Well, estimates of expected returns, also from relatively long samples, do not always reflect the true expectations of market participants. So, for example, there can be a crash risk that investors take into account even though no crash has occurred. And so then the average returns in the sample seem high if we don't take the crash risk into account. In other words, if some trades seem really profitable, then it's perhaps because you are ignoring some major risks, so that the returns are actually in line with the risks, but if you're ignoring some of the major risks, such as these crash risks, then it will seem like those returns are too high, and also that the returns to some strategies like these carry trades that I talked about before seem too good to be true. So then you should be a little bit suspicious that you might in fact have ignored some major risk here. Okay, that was all I wanted to say about the peso problem.